Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of February the 4th, 2019. Now, to get started this week, we're going to have a brief discussion about the Fed and, of course, the non-farm payroll number. Now, what I'll draw everybody's attention to here, which is a little perplexing, that if this is a good number, then we've basically got about 500,000 jobs swing in the wrong direction. So basically, last month on the U6 number, we were 7.6. The U6, by the way, is the broader unemployment, not the U3 survey number, which again was kind of a mess this month, where we've had a revision downward of 90,000 jobs from December. So I'm not really sure how they managed to mess that up so badly. Of 90,000 miss. That's fairly substantial. But what's really substantial is going from 7.6 to 8.1. That is absolutely moving in the wrong direction for the US dollar and the unemployment situation in general. So, this is part, I would assume, because of maybe the government shutdown, but they're telling us that the government shutdown did not affect the unemployment numbers, but something has caused a 500,000 job swing. Basically, that's saying there's 500,000 more people out of the market, not in the market. So when we look at that, not surprisingly, the dollar's been under significant selling pressure for the last week or two. Now, the critical levels that we want to watch, and I will point out what I've discussed in the live training room and with my own direct clients, we know the dollar usually strengthens on demand in the first week of the new month, regardless of these silly economic announcements that, everybody is trying to interpret them. Is it bullish or bearish for the dollar? So we really just want to look at basically when the major players have to buy US dollars, it's usually in the first week of the new month, regardless of what the overall trend is. So we have to be cautious of that. The indicators are very, very slowly trying to roll over on the long here. We see our medium term crossing our long predicted difference with our neural index, both of which suggests we could be moving higher. Now, taking the VantagePoint critical long-term crossover by itself with just the blue line, taking the correlation of 31 other markets when we forecast the target market, a break of 95.36 should see some dollar buying. We've had basically 1, 2, 3, 4, 5, about 6 down days in the dollar going in towards month end. Now, as we move into the first week of the new month, we should see a little bit of dollar buying. Now, we compare that, or I'm going to compare that directly to gold. Gold is starting to get a little bit toppy up here. We've had a good move up, which I forecasted basically over the last several weeks, that I felt that gold was going to continue to rise here. But again, the actual original buy signal on VantagePoint on gold, I will further point this out, was all the way back in November the 30th of 2018, and the indicators in VantagePoint have remained fairly firm that we are going higher in gold. So nothing goes straight up and nothing goes straight down, and we all know the markets, or most of us know that the markets don't work that way. So gold, it looks to be getting ready to take maybe a little bit of a pause up here around 1330, 1335. Watch out on Monday trading here, guys, for a big push to the upside on gold, only for it to reverse on Tuesday as money starts to slowly move its way potentially into the US dollar. Our indicators are getting a little bit toppy. Our shorter term indicators are already breaking down. The RSI has been in heavily overbought territory at the 90 level for the last 2 trading sessions, all of which tend to warn me that gold is probably getting ready for a corrective move lower. So the critical VantagePoint pivot area to start the week, 1366. Gold is still long, guys, if we can hold above this level. But my optimism on that going into next week remains heavily guarded. Now, as we look at the equity markets having a good January, but once again, this is not really on stock demand in my respectful opinion. It's about the Fed, the anticipation of the Fed pulling out of the market. And that's basically what Powell said this week. But there was still some underlining, he wasn't completely dovish in my respectful opinion. And the market now, we're going to see if stocks can move higher. But again, in my respectful opinion only, the market is bought into the fact that the Fed is not going to hike rates. We've got a dovish Fed. Now some people are starting to second guess that after the unemployment report. So we've got to keep all of this in mind, and remember the real price will start to show itself on Tuesday of next week, not on Monday. Even with my own guys, I advise them to stay out on Monday and focus on the reversal, the potential reversal on Tuesday. Now, to get started again, the critical pivot area that we want to watch, 2673, that's also somewhat of the makeshift breakout point from this verified resistance level here. That comes in at 2687. So if this is really a true move to the upside, I still say it's going to be very, very limited to between 2845 and 2940, where we start to get into the really, really heavy resistance where you can see it up here. So we've managed to push into the first level of verified resistance. No reason to panic or think that the markets or the S&P is going to go to 3,000, because the probability of that is almost nil. The probability that the stocks turn lower sooner rather than later is still relatively high as the market tries to digest this very complicated Fed. Now, oil also really not doing much over the last couple of 2, 3, 4 weeks here, holding in this resistance level, these verified resistance levels up in this 54 area, an even bigger one that comes in here again around 5506. That should contain oil unless the equities break out, but again right now I'm not convinced, that the stock market is going to follow the Fed departure, because I'm not convinced the Fed is completely departed from the market here. And remember, the central bankers are notorious for talking out of both sides of their mouth. Next month, they could turn around and say the exact opposite. So don't put all your eggs in one basket and bank on the Fed here, okay? I'll leave it at that. Now, as we go into our main Forex trading this week, the one thing what we've noticed here with the VantagePoint software is the euro doesn't particularly like it when the stocks move higher. And you can see it starting to back off. Then this began on Thursday of last week, right after the Fed. The euro kind of tanked. Now we're holding above that critical VP level, 114.19. We need to stay above that and close above that if the euro is to retest these highs. But any move lower in the euro, in my respectful opinion, is a buying opportunity, guys. There is no big trending move, despite what you're hearing these pundits say. The range in the euro is very identifiable by these verified zones. The overall range between 112 and 115.60 approximately, still very much in play. Now, if we look at the critical VP long predicted, just the blue line, that pivot is 114.40. We're closing 114.54. We want to make sure we're holding above this blue line for all our VantagePoint users. If we're above it, we're long. We're below it, we're short. The indicators are very, very slowly trying to turn over for a short, but if the equity markets turn lower, that will likely be a positive for this particular currency pair, which, by the way, is the most heavily traded Forex pair. So definitely a pair to keep our eye on. Now, with the US Swiss franc, the verified resistance is holding as long as the equity markets stay down below that 28.30 area, or there isn't any aggressive buying in stocks. But right now, we continue to bounce off this critical VantagePoint T-cross long 99.14. Longs carry a very, very slight edge while above this area. When we back it down a little bit, you can see that we've got a nice little triple bottom forming there at 99.04, which could be used as a springboard for this to go higher. But what do we need as Forex traders for this pair to go higher? We need gold to go lower, and we need stocks to move higher, guys. That is the trade. So if you're trading this pair, you need to watch those two markets that I just discussed, because they are critical intermarket drivers of the Swiss franc and subsequently the US dollar. Now, as we go into the pound dollar for next week, getting a little toppy. As we've got up, as I discussed in last week's Forex Weekly Outlook, that we have very, very strong headwinds up in this 132.80 to 133.50 area. We're failing there, but we're still holding above the T-cross long. So the move lower for now is corrective in nature. 129.96, a key area. But my concern for longs here is that we've broken under that long T-cross, or the long predicted 131. We're closing 130.79. The market could very well, again, use this level to accelerate the move to the downside. That move would then likely have us target around 128.91, but ultimately the pound is likely to go higher, but also somewhat dependent on stocks moving higher. And I do get a lot of questions about stocks, and just a quick little revamp when we come back here. When we look at stocks from 1 year ago, basically from 1 year ago, you can see here on February the 2nd, we closed at 27.73. This year we're sitting around 27.04, but there was a very violent sell-off in this coming week last year at this particular time. So just keep that in the back of your head for now. That, the stocks, because again, the stocks can't go up solely based on what the Fed isn't going to do. That will run thin unless we get a good trade. The U.S. gets a good trade deal with China, the political situation in the U.S. starts to calm down a little bit, then stocks are always going to be a very risky investment here, to say the least. Now, as we look at dollar yen, I had talked extensively about this last week, about these verified zones around, basically around this 110 area, 109.80. That we had a significant failure at that level. The dollar yen going all the way down into the 108.87 off of this verified resistance. But if stocks turn higher, guys, then we could have a very good long on dollar yen, at least short term, right? Even with US, if we're coming into a week of known dollar strength and the equity markets are starting to firm up, we could see a long on dollar yen. The employment number has pushed us above the long predicted 109.35. We've closed 109.49. We could see a break. If we can break through these verified zones here, more specifically the 110 area, as I said in last week's Outlook, I suspect we have exotic barrier options sitting around this 110, and somebody very big is protecting the 110 area. So if they can't hold it below 110, we get a snap break. It's going to take gold to move lower. That will hurt the yen, and stocks to move higher. These are both negatives for the Japanese yen and positives in this particular case for the US dollar. So once again, guys, we need to break through 110 and we need to hold above 109.35 in order for this pair to get moving. Now, with the U.S. Canadian, the Canadian dollar is indisputably the strongest currency in the Forex market right now. But that's right now, and things change very quickly. We have the Canadian unemployment report coming out on Friday. I'm not anticipating a great number there, and even if we do, if equities sell off a little bit towards the latter part of the week, and gold is a little weaker, oil's a little weaker, then U.S. Canada will reverse and start moving higher. We've moved a considerable distance from the long predicted at 132.63, but the key level to watch again is taking our long predicted 131.81 and seeing if we can get above this. Now, if we look at for Monday and Tuesday trade, if we come up and kiss this level and it fails, then that tells us that we are getting ready for a bigger move to the downside. But we have very formidable support down here that is also not going to give away very easily. And that goes into this, you can see where I've got it all blocked out here, down to 130. But, in order for us to get below there, we need a strong Canada jobs number on Friday, and we need stocks going higher, oil going higher. That will help the Canadian dollar. Without that, the Canadian dollar will come under pressure. Much like the Aussie and the New Zealand, guys, I hear a lot of people, arguing about, it's bullish, it's bearish, everybody fighting it out on these websites. The reality is, guys, this is a stock trade. If we look at the stock trade here, and we come in here, and let's go here for let's go to take this all the way down to even 1 week, or maybe we won't go quite that low. We'll go 1 month. So we can see some of these big green bars here, right? And when we look at the Aussie dollar and we do the same thing and we go into a 1 month bar, the charts are almost identical here, virtually identical, right? So if the stocks move higher, Aussie US moves higher. Right now, that key pivot area is 72.25. The next move on this particular pair will not be determined by the Aussie currency or the Aussie fundamentals. It'll be determined by the direct intermarket correlations. And if stocks go higher, then that is going to absolutely help the Aussie currency to also extend its gains. So keep a very close eye on stocks if you're trading both Aussie and New Zealand. Now, New Zealand has a critical support all the way down the T-cross long, 68.15. The further we move away from it, guys, the more likely it is we're coming right back to it. Don't buy into the Elliott wave Fibonacci nonsense. It's strictly we're going to run out of buyers up here, and if stocks cannot hold their gains, that is what will be the catalyst to send both the Aussie, the New Zealand, and the CAD lower. So always try and remember that. And to fine tune it a little closer, again, using that long predicted, the long-term crossover with just the blue line as a pivot area, the Aussie has enjoyed 2, 4, 6, 8 good trading days. Might get 9, but nothing goes straight up and nothing goes straight down. That's just the nature of the beast. The markets are only trending 20% of the time. That is that is absolutely factual, regardless what market you're trading. So after we've had a 9-day run up, and we're coming up against a verified resistance zone, the probability that these two turn lower is very, very high. So with that said, this is the Forex Weekly Outlook for the week of February the 4th, 2019.